Our first paper of this morning has the title, Lay Down Your Arms, Disarming America of Killer Mortgages. Please welcome Cole Fay.
Darn. How many of you immediately thought of mending your holy socks? In fact, how many of you have ever repaired a sock instead of just throwing it away and buying a new pair? Since America was conceived, it has progressed at a frantic pace. As machinery and materials have evolved, the disposable nature of clothing has made the technical use of darn entirely obsolete. Until the early 20th century, homeownership was a matter of personal pride and a mark of accomplishment. The labor and pride that went into a home kept patience and hard work at the helm of a homeowner's success. It is the absence of this that permitted the rise in on-demand housing. Today, we go through houses like we go through socks. The primary difference between today and a century ago is distinct: instant gratification. The medium for this evolution was the 30-year fixed-rate mortgage. Instant gratification created a multi-trillion-dollar loan industry for those who simply could not afford a home. Lending agencies came to rule the housing market and dictate who could live where and for how much. That being said, they had to continuously come up with new and more complicated ways of selling a borrower a home for which they did not have the liquidity. The method in particular to be evaluated is the adjustable rate mortgage, or ARM. As an amendment to the National Housing Act in 1929, the Federal National Mortgage Association, known as Fannie Mae, was assembled. It aimed to help repair the 25% of mortgages in default at the time by selling and regulating home loans in the U.S. In 1950, Fannie Mae became a government-sponsored enterprise, meaning that it was privatized, but the government had a say in its business decisions. In 1970, the government founded the Federal Home Loan Mortgage Corporation, or Freddie Mac. Its aim was to do what Fannie Mae did prior to being revived as a government-sponsored enterprise. Now, fast forward almost 30 years to President Clinton's push towards an expansion in lower-income housing. Essentially, he requested that the government find creative ways of getting low-income families into homes by any means necessary. This began the massive housing push of the early 2000s. Both the government and big banks were incentivized to put these particular loan applicants into subprime mortgages, which are loans given to those who are considered a higher than normal credit risk, with a credit score below 600. Susan Wachter, professor of finance at Penn State University, said, in 2002, observers noticed a decline in lending standards and an increase in non-standard mortgages. This resulted in $2.7 trillion worth of very high-risk loans. Not only was this number unprecedented, but it was about 3 times what it had been during the Great Depression, factoring inflation. Starting in 2004, lending practices were largely relaxed due to what is called a loan resale. Essentially, with the help of the Federal Reserve and the National Treasury, the government-sponsored enterprises would purchase about 2/3 of all mortgages from the primary lender, meaning that the banks were almost immediately wholly reimbursed. To put it simply, the government bought loans, subprime or not, from the banks across the country, making the government the primary owner in all of that property. This put the government in over $2 trillion worth of debt. 75% of those resold loans, by the way, were adjustable rate mortgages. Although adjustable rate mortgages may appear advantageous by making seemingly affordable loans available to the masses, in reality, they damage the national economy and leave millions of people in debt. Dishonest and irresponsible lenders monopolize the housing market and in turn the investments of millions by providing unpredictable mortgages to irresponsible consumers who inevitably cannot afford the fluctuating interest rates. Historically, America has used legislation to restrict private actions that have that for the sake of the general welfare, along with more specific lending restrictions. Therefore, the government ought to do their part and illegalize the adjustable rate mortgage. ARMs are largely considered a problem because of mal-lending practices. They directly benefit the institution that operates with the intent to make its monthly quota of loans written, rather than help people achieve the American dream of homeownership. Lenders lie, or at the very least, they steeply exaggerate to borrowers about their eligibility so that they accept a larger loan with more interest. Susan Wachter explains that the lenders were able to pass a lot of the risk onto a less informed market of secondary investors. Lenders would then use any means available to get the most of these uninformed subprime borrowers. Lending brokers answer to owners of their firms who are motivated by lofty federal incentives in the form of loan resales. So while the person writing your particular mortgage may not have devious, selfish, malicious intent, his firm certainly does. On the other hand, the credit risk associated with subprime borrowers has caused massive instability in the market that spread to those who were almost entirely uninvolved. In just 1 year, between 2007 and 2008, in metropolitan areas across the country, home appraisals dropped by 30%. This meant that owners could not sell their homes and move for any reason without possibly losing hundreds of thousands of dollars. This was largely thanks to the negligent and impatient investments of subprime borrowers who took on loans that they did not fully understand. When their loans defaulted en masse, the housing market collapsed. New buyers with home fever notably bought houses far outside of their means because these mortgages made it possible. The United States of America has historically used legislation to restrict and often prohibit private actions that have a profound effect on the general public. For instance, California recently officially raised the legal age of tobacco use to 21. Some may think that the government regulating what one person puts into his body would prove to be a waste of resources and an imposition on our given freedoms. However, tobacco poses many proven health and financial risks for everyone involved via first-hand inhaler complications or raised taxes for hospital bills. This legislation aims to protect individual people from hurting themselves with regards to first-hand smoke, but primarily it protects those around them from having raised taxes due to compensation for hospital bills. This parallels with ARMs, as they not only bring harm to the user, but also to those around them and the national economy. Between 2000 and 2005, the prevalence of ARMs raised by 40%. But this spurred a spike in home prices across major metropolitan areas. In San Diego, 127%. The federal government incentivizing homeownership created an artificial spike in home prices. This created a bubble, the bubble, which would burst. In just 2 years, 75% of all ARMs started to default. When said bubble burst and home prices plunged, those who purchased houses at the peak of the market with any kind of mortgage almost immediately lost hundreds of thousands of dollars. It would be useful to note, too, that the government has taken previous legislative action on lending practices. The Equal Credit Opportunity, or ECOA, disables lenders from allowing physical characteristics to impact a loan approval decision. So lenders cannot deny a loan, target specifically, or alter lending qualifications to anyone based on physical characteristics. This act aims to greatly suppress, if not eliminate, predatory lending. So too, for these reasons, it would not be unprecedented for America to take legislative action on mortgage lending practices. Some may still argue that it is not in the government's standing to prohibit private actions in the form of investments to lending firms. After all, is it not to the borrower's discretion as to how much they can afford to pay for a mortgage each month? While this may be true, why should the credit affluent, successful, honest, mortgage-paying citizens have their investments threatened by these people? By subprime borrowers being allowed to learn their lesson, they drag down those who were wise enough not to partake in such loans initially. Natural consequences are a beneficial part in gaining life experience, granted, but at what cost are the wise Americans supposed to allow these people to negatively affect them for the learning purpose of subprime borrowers? It is not a matter of whether some can handle the fluctuating interest. It is the fact that the abuse of these loans that were interest-strapped devalued the American housing market, henceforth devaluing the property of millions of unexpecting citizens. To those who lost their life savings in equity, to those who lost their jobs, to those who lost their homes, rendering their families homeless, because of millions of evidently careless bets, you may have lost and can still lose financial security in a way that can shake a family to its core. Because the detriments of an ARM outweigh the benefits, the government ought to do their country the service of taking legislative action on the legality of the adjustable rate mortgage. Thank you.